Welcome back to Alpha Recap, your weekly rundown of the biggest themes our research team covered. Markets were closed for the weekend, and as always, if you have questions, you can reach us at stockalpha.ai. Today we're unpacking AI dominance, event risk, and why cash flow resilience mattered this week.
Thanks for having me. Lots to cover. 9 research notes this week with some tight themes threading through them. Right.
Okay, quick setup. 3 dominant takeaways from the notes: AI and platform dominance, event-driven volatility, and cash-generative franchises as lower beta exposures. Let's start with AI. Your quick read?
So, what really stands out here is that NVIDIA continues to sit at the center of the AI infrastructure story. The research called it the de facto supplier for high-performance AI training and inference. Analysts stayed bullish, even though current multiples already price in a lot of growth.
And the numbers were eye-catching. NVIDIA was referenced at about $198.45 and a market cap of about $4.8 trillion, right? That's huge.
Yeah, that tracks. The node emphasized the ecosystem feedback loop, hardware, frameworks, and developer adoption, which widens the moat. But they also flagged valuation sensitivity. In plain terms, great momentum, but the price already expects more great things.
I mean, when you step back and look at this, it's the classic question. How much of the future is already baked in the price?
Exactly. Analysts are balancing structural upside against the risk that a slip in execution or a macro hiccup pressures expectations.
Moving down the stack, services and applications. We had a bunch of software names in these notes: Globant, Okta, DocuSign, and a curious one, Splunk.
Splunk was the oddball this week. The research actually admitted that public data was incomplete, missing market cap, industry classification, and even financial statements in the dataset they referenced. So instead of a single valuation, analysts ran scenarios and leaned on technicals for short-term setups.
Wait, really? Missing the basics?
Honestly, I was a bit surprised by this one. It's a neat reminder that sometimes you can't force a point estimate when the inputs aren't there. Scenario analysis and comparable frameworks became the default.
Short reactions. Fascinating.
Right.
Let's unpack a few of the software names more concretely. Globant. They were called out as positioned to capture digital engineering and AI integration demand, but they're also facing legal overhangs. The note had a current price heading into the long weekend of about $40.62, and the stock was trading near its 52-week low ahead of earnings.
Correct. So the thesis is positive on demand for AI services, but 2 flags: class action notices, governance and legal risk, and operational leverage that hasn't translated into high returns on equity yet. The near-term catalyst is an earnings print on May 14th. So that event could drive volatility.
Got it. That's a classic event risk setup. Good secular story, near-term execution, and legal noise.
Right. And the other thing is that event-driven volatility wasn't unique to Globant. We had a cluster of earnings and readouts. Bill Holdings had earnings on May 7th, Vertex had pipeline-related news in early May, and Intuitive Surgical already reported a first quarter beat.
Bill, the payments company, they're expanding into travel for small and mid-sized businesses, and the research noted they had a strong cash balance. Prices were near recent lows going into their print.
Yep, the research said consistent revenue growth and positive free cash flow, and that cash balance helps fund product launches like Bill Travel. But estimates were mixed, so the market had some skepticism about near-term profitability despite the growth runway.
DocuSign got a neutral take. AI-enabled agreement management could increase contract value and reduce churn, but they've got a current ratio below 1 and high stock-based compensation, which raises execution risk. The price reference was about $47.97, with a price-to-earnings ratio of about 30.
Exactly. So you have product momentum from AI, but the balance sheet and compensation dynamics are real constraints. That's why analysts called it balanced rather than clearly positive.
Okta had a neutral stance as well, with a price-to-earnings ratio north of 50, about 57, and a price around $75.78. Identity remains a secular growth area, but premium multiples and leadership transitions raised flags.
Yep, the story is solid. Demand for identity and access management is durable, but a lot is priced in, and near-term EPS pressure plus execution risk from leadership changes put analysts on neutral watch.
Let's pivot to the healthcare and biotech side. Vertex was highlighted as a cash engine with a dominant cystic fibrosis franchise. The price cited was about $424 and a price-to-earnings ratio of about 27.
Vertex looks like a classic cash-generative biotech. High margin, recurring cash from an established franchise, and upside from a maturing pipeline. But the research also pointed out that pipeline execution and trial readouts are binary catalysts that can swing sentiment.
Intuitive Surgical reported an EPS beat for first quarter of 2026, and the research emphasized the stickiness of consumables and recurring revenue from instruments and services. Price noted was about $457.78.
Right. High margin recurring revenue makes it resilient. The risk is premium valuation. It prices in continued procedure growth and successful new product rollouts.
Danaher was an interesting balance of trade story. The company beat first quarter EPS and remains a leader in life sciences tools. But analysts flagged the financing around the Massimo deal, issuance of multi-billion euro debt, which raises near-term leverage and integration risk. The stock was trading near its 52-week low.
Exactly. The research frames Danaher as a trade-off, strategic portfolio expansion through M&A versus the short-term drag from higher leverage and slower margin recovery. That debt load matters for return on equity in the near term.
A quick here. Balance sheets really mattered this week, huh?
They did. The notes contrasted Vertex and Bill's cash cushions with Danaher's elevated leverage and DocuSign's liquidity ratios. Analysts were slicing exposure by balance sheet resilience to manage near-term uncertainty.
Let's step back and talk about cross-cutting methodology. The research repeatedly used scenario analysis for event risk and, in the case of missing data, for companies like Splunk. Can you explain scenario and probability-weighted frameworks in plain English?
Sure. Scenario analysis is basically building a few plausible futures, say a good outcome, a base case, and a bad outcome, and assigning probabilities to each. Then you weight the outcomes to get a range of values. For binary events like trial readouts, probability-weighted models help quantify potential upside and downside, rather than pretending you can get one precise number.
So instead of saying, this is worth X, analysts say, here's what happens if A, B, or C occurs, and how likely each is. That's more honest when the outcome is binary.
Exactly. And when public data are missing, like with Splunk in that research dataset, analysts will lean more on comparables and technical price levels for short-term trades until proper disclosures arrive.
Short reaction? Makes sense. Let's highlight the main cross-article themes the research team pulled together. First, AI remained the dominant secular narrative across infrastructure, services, and applications. Second, event-driven risk clustered in early May, increasing idiosyncratic volatility. Third, valuation dispersion is wide, from multi-trillion-dollar infrastructure names to elevated software multiples. Fourth, balance sheet differences drove distinctions in risk profiles. And fifth, data completeness can force different analytical methods.
Yep, that's a good summary. To add, analysts also emphasized metrics specific to each sector, recurring revenue durability and stock-based compensation impacts in software, total addressable market and ecosystem effects in semiconductors, and cash flows and pipeline probabilities in biotech and medtech.
Now, for listeners who trade around catalysts, what practical steps did the research suggest? Not advice, but what they noted analysts were watching.
They highlighted mapping the event calendar closely, earnings dates, trial readouts, M&A milestones, and stress testing models for binary outcomes. Analysts also put more weight on balance sheet resilience where uncertainty is high, and recommended being explicit about rebalancing thresholds. Again, that's descriptive risk management, not prescriptive advice.
Good distinction. We have a few contrarian takes in the notes, too. A buy consensus on Globant tempered by legal risk, a broadly positive view on Danaher counterpointed by deleveraging concerns, and a nuanced bullishness on NVIDIA that acknowledges valuation already reflects strong growth. Those were called out as notable perspectives.
Right. The research balances conviction with humility across these names. Even where analysts were bullish, they flagged what could go wrong.
Let's close with what to watch next week. The calendar items that could move markets once trading resumes.
Key things. Globant's first quarter results on May 14th and any legal commentary. Bill's earnings from May 7th to gauge travel product traction. Okta's first quarter fiscal results for revenue reacceleration signals. Vertex's pipeline readouts and earnings in early May. And updates on Danaher's Massimo integration and debt plans. Also watch any commentary from NVIDIA on data center capex and channel dynamics. That'll influence AI hardware expectations.
And for Splunk and similar cases, keep an eye on filings and disclosures that could convert scenario work into standard fundamental models.
Absolutely. Data completeness matters a lot for analytical certainty.
Final takeaways in 3 bullets.
1. AI remains the structural story, but valuation sensitivity is real. 2. Event-driven catalysts clustered in early May increase idiosyncratic volatility, so map your calendar. 3. Balance sheet and cash flow resilience meaningfully change risk profiles across sectors.
Short reaction, clear and concise.
Thanks.
Quick reminder of the investment disclaimer. Our coverage presents analysis and data for informational purposes only. Analysts note market signals and risks, but do not provide personalized advice or specific buy, sell, or hold recommendations.
Right. Treat this as market color and process guidance, not tailored investment direction.
All right, that's our Alpha recap for the week. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you next week.